Hey guys, Mike here. So ready to get to answer all your questions and comments for the week, and there were some pretty good ones in there about Nvidia stock split. And I'm actually going to include a clip from the members video I put out Thursday for them in this for you, and we'll start off with that. Also talking about rate cuts and all this other stuff, and IWM small caps, and what happens when the Fed cuts rates and all this other stuff. So I'll show you some stuff you might not be aware of. People are way too focused on the rate cuts, and I'm going to show you why when it comes to that, and then a few other questions. So I appreciate all of your questions and comments. Please feel free to participate in the bottom, answer some of these questions, especially a couple at the end as well. I always enjoy reading the comments and stuff, and any more questions you have. So as usual, let's jump right into it. And the first one says, hey Mike, how should one play Nvidia stock buys and options after the stock split? And I'm just going to, like I said, include a clip from the members video, and then I'll pick up after that about when it comes to stock splits in general, especially Nvidia. When it comes to these stock splits, we got a big one coming up on Nvidia, and everybody's used a blanket statement saying, man, it's going to sell off just like all the rest of them has. That could happen, but understand it's not about the stock itself, okay? If you just look back at the other stock splits it's done, you see here, did a stock split right there, sold off before the stock split, about 4 to 5%. And then, of course, rally, right? Another 14% after the split, and just kept going after that. Because understand, imagine seeing Nvidia, let's say it's at 120 bucks a share. That's going to be pretty shocking to some people to see that versus they're looking at it now going, oh my God, you're talking about $1,200 a share, whatever it is now. And so, keep that in mind. That's why people do flood in. People start buying more options on it because the options becomes way cheaper. They're more expensive now. But the thing you really want to look at is what's going on with the market, right? That's what matters the most. And you can see right here, this is the Qs I believe I pulled up, or the SPY, whichever one it is. But you can see it was going up. Just like you see on the dip down, the market was dipping. All right, you look at this one right here for Nvidia, right? What was happening here, right? The stock split ends up happening. The thing roars. What's happening in the market? The market's roaring, right? It's moving up. It's going up. So that's what matters the most, is what's happening in the market at that time. We go back here. You can here's the other stock split from 06, and you can see clearly market's going down. What happens to Nvidia after the split? It goes down. And so that's what you need to be paying the most attention to. And the other thing to look at is, and this is normal too, when you hear these stock splits announced, right? May 21st, 2021, they announce it. What happens? Stock just roars, right? What are you seeing now? The stock is roaring up. This is normal to be running up into the split, okay? And then, of course, that's why you do see some dips when they finally split, because people start taking profits and stuff, right? And start selling, because now all of a sudden they have a boatload more shares they actually can get out of. And just secure some profit, right? And then if it does dip down more, they usually buy back in. That's the way it works. Here's another one, August 9th, 2007. They end up announcing the stock split right here. And you can see, what's it do? It runs up. A lot of times these are announced on earnings, right? But it ends up running up into the split. So that is normal. It's normal what we're seeing now. It's not like it's fundamentals or anything else. Even when you see other stuff selling off, the market looks weak right now. People are just piling in, pushing this up for now, right? And then you look at this one right here. They announced this stock split on the earnings right here. What happened? It ran up, right? Had a big run up into that split. And so again, this is normal. And then we look at other stock splits. So it's not just Nvidia. Look at Tesla. Boom. Sells down on stock split. Massive sell down on stock split. But here's the key. What was happening, right? The market was selling off. It was going through a correction each time. So Tesla has like the worst when it comes to timing, when it comes to these stock splits, right? And so you see the S&P down 8% as Tesla's selling off, the market's selling off. So that is okay. You go back to the other stock split they did right there. We're in 2022. What was going on? Markets were crashing. We were in literally a crash. And so, yes, it sold down. And so when Tesla does a split so far the last two, then it's been really bad timing for them. Now, go to Walmart, right? That was one of the most recent ones we know. And this is a retailer. It's not a tech stock, but what did it do? It announced it. It actually announced it way earlier than this, but you can see right here, there's the split, right? You had a nice little dip down of 2%, and then it went on to all-time highs. But when you look, they announced the split, not during an earnings call, but they announced it on January 30th, 2024, and this is Walmart, not a tech stock, right? And this thing ended up going up like almost 10%, and so before the split happened. And so again, it's not a tech stock, so for a grocery store chain to go up that much, that's actually a lot. Right? You go on to another one here we're going to look at. And then last one, you go to Microsoft, right? I got the market pulled up over it. There's the split. There's the market. They're identical. of the dot-com bubble, right? If we pull out, you'll be able to see what I'm talking about, but there's 2000, 2001, 2002. So that's when we were bottoming at the dot-com bubble. So again, probably not a great time to do the split, but again, it's all about what's going on in the market, guys. And this is really the things you have to remember when it comes to the Nvidia stock split. And before we continue, guys, please hit that thumbs up down there. It helps people find the video. I really appreciate that. And think about subscribing if you like these kind of videos. One, what is happening in the market? Okay, do we continue this weakness, or do we bounce coming up this week, right, and start heading back up? That's what we got to see. That's the most important thing. I hope you got that out of that. Number two, the options are going to be way cheaper, right? Have any of you guys bought Nvidia options lately when they're sitting there, the stock's at 1,000 and 1,100 stuff, or even tried to sell them, right? So now more people will be selling the options because it's going to take way less collateral to be frozen in your account if you're selling, cash secured puts. And then more people are going to have more shares now. So a lot more people have 100 shares, 200, 300. That's now that they're able to sell a lot more covered calls, all kinds of stuff we have in the options market, and just playing regular options, right? Calls and puts and stuff is going to come into it. And then, of course, when people, the psychological part, they're going to see it and go 120, 130, whatever it is when it splits, right? Versus over 1,000, they're going to be like, and people are just going to buy on that as well because they want to build up and they're willing to dollar cost averaging at that price versus buying one share at 1,000. Even though I know, trust me, it's all the same stuff. It's just easier to, I guess, look at, and I understand that. So there's a psychological effect. So that's what you're going to see. And so if the market's going down when it splits, Nvidia's going down with it. If the market's roaring up or going up, then Nvidia could have a small dip, but most likely will continue to either trade sideways or higher. That's what I showed you in the other one. So we'll see how it goes. Let me know what you're doing in the comments when it comes to that. Now, next one right here comes from Dr. Marcus, and he says, hey, question for you, Mike. If the Fed cuts rates between September to January, which is good, obviously, they will likely cut 0.25% at a time which, in all honesty, is nothing. Small caps will still be hurting well into 2025 if they only cut 0.25% every 2 to 3 months. We need them to cut 1% at a time to really get the party started. Would you agree, or am I way off? Love your channel, buddy. Honestly, really what it comes down to is, let me ask you a question. Right here, IWM does this huge move, right? 32% in 150 days. Okay, so that's a massive move, right? And I got to ask you, how many rate cuts did the Fed do when that happened, or even before that happened? And the answer is 0, right? Again, they had raised rates, and then they just paused, right? No rate cuts for IWM to move at all, right? Here's another big move right here. What's going on here? That's a 18% move. What was happening? They were raising rates. They're actually raising the Fed funds rate when this happened, right? So there's this kind of myth that we've kind of talked ourselves into to say, man, if they're raising rates or they're not cutting, small caps just can't move. And unfortunately, small caps, especially nowadays, don't trade anywhere near off fundamentals at all. Remember, a third of them don't even make any money. Okay. Now, what you got to look at here, let's go back to when they did cut rates. Here's a big move up coming out of a crash, 20%. They had paused and everything. You look over to the right, you see when they started cutting right here, and we did not go into a recession when they started cutting, right? Remember, the Fed cuts to avoid recessions, okay, and keep the economy churning. Now, you can see when they started cutting, what did IWM do? Basically nothing. It was basically flat for like almost 4 months, even after they were cutting here. So it didn't do anything. And the economy was supposed to be still good, right? But the main thing to look at here is not the Fed funds rate, it's the 10-year. That's what you want to pull up. If you look at when we started going through this right here, why did this thing start churning and burning? Because yields plummeted, right? See, there's an inverse relationship. That's what you don't want to see. If yield, that's what it's been happening lately. Yields have been heading towards 5 again, and it's been scaring the brakes off of small caps, transportation stocks, all that stuff, right? So it's the yields that matter more than the Fed funds rate, because the yields are dropping even when the Fed funds rate is not, because the market, the bond market is saying, hey, they're going to have to cut, right? That's why we're dropping here. If you go back, I mean, pretty much any point in time, really, you'll see it when there's a big drop in yields. The IWM actually loves it. And one thing we're going to get out of this right here and stop this myth is that small caps, transportation stocks can't go up when the Fed funds rate's going up, which I showed you it can. When yields are going up, it can. The thing is, look right here. Remember, this is 2020. What's going up with IWM? Yields, because they dropped them, basically dropped to nothing. It's just when you get to a certain point, when the yields get to a certain point, that's when IWM starts to have trouble. Also, that's when money just starts shifting over to the larger stocks. Because, like, what's the point? If we projecting yields to go up, because remember, it's forward thinking, then we need to get out of IWM, right? So if the 10-year drops, IWM is going to go up, just like you saw on Friday. If the 10-year does head back to 5, small caps are going to get crushed. That's just the way it is. Now, that kind of leads me into this one right here. Why do stocks crash after the Fed cuts rates? Isn't that considered loosening financial conditions? Love the terminology, by the way. And yes, the reason why that isn't loosening financial conditions. But remember, guys, what are we seeing? A slowdown. Right, already. They cut to try to avoid this kind of stuff, to avoid a recession. And you see U.S. firm announces fewer new hires in April. 2024 sees slowest first 4 months of hiring since 2016. And so, we go over here to all these layoffs you're seeing just in tech companies, by the way. Just in tech, which I picked this up because tech pays really good wages, right? It's not like you're making minimum wage at these tech companies. And you can see it's thousands of layoffs. And look over here where 2024 starts. And then look at 2023. Which one do you see the greater number of layoffs starting to accumulate? It's in 2024 already. You can see it, right? So it's building up. That's why you see the unemployment rate actually starting to go up. And when it starts to go up, it usually will start to pick up pace. And this is just tech. We know plenty of other industries that have laid off, that talked about slowdowns and stuff. But the key thing to take away is just remember, when the Fed cuts, they're not doing it out of the goodness of their heart. When they started cutting in 2019, July of 2019, it was not because Donald Trump was tweeting, you're going to kill the economy. His columns were telling that, right? But they could see the data. It was starting to slow down, okay? And so we were supposed to go into a recession probably at the end of 2019, early 2020, just normally, right, with the business cycle. But that got all turned upside down. But they started cutting to try to avoid it, right? They've tried in the past. It didn't fail. They cut too late because the data they use is lagging data. That's why you're seeing that every time they report data. It's like this is such a lagging. It's crazy that they do it this way. But that's the reason why they cut if they're going to cut. The X factor on this one is inflation. People can predict all they want. Nobody knows. Are they really serious about getting it down 2%? Because if they cut too early and all of a sudden, we don't go into a recession and all of a sudden demand starts to pick up for housing and other things that are rate sensitive, what is that going to do to inflation, right? Demand is going to go up. And you're going to see prices start to, inflation definitely going to keep coming down. That's for sure. It's going to be really stuck then. It's already hard enough to get it down now from where it's at to 2. Right? If they do that, then they know they're screwed, right? Now, the one thing I don't know, because we're in a weird situation, is XLF. I told you Thursday that banks definitely are underwater. I'm going to show you what I'm talking about if you didn't see that. But when they cut rates, you can see, obviously, financials go down with it. This is '08 right here. We'll head back down to the dot-com bubble. You see the same thing. And, but the key and the weird thing is what we've never seen before is the chart I showed you on Thursday was how much underwater banks are on these bond portfolios. We'd never seen anything like it. And so, if the 10-year can drop, if the rate, because we saw when the Fed starts cutting rates, the 10-year is already coming down, right? It is already going ahead of time. And so if they cut rates, what does XLF do? Because if you think the bond portfolio is going to start looking a lot better. And what would that do? If they start cutting rates, all those commercial loans are underwater on. Maybe that starts to pick up. Maybe the real estate starts to pick up, all that stuff. The one thing, remember the Fed, when they do cut rates, what else does that do? The bank actually is going to make less money on when it comes to lending it out because they'll be lending it out at a lower rate. But at this point in time, it can't be that busy, right? So maybe it'll pick up enough to where it'll offset that. But that's the one thing I don't know. We've never seen anything like that before. So how will the market react? That's what we got to find out. Remember, the 10-year will start to go down before they cut rates. Okay, it will start to go down before they start to cut rates and stuff. And don't even forget about the yield curve. We don't really talk about it because it's been inverted for so long. People almost forgotten about it. But the yield curve hasn't even uninverted yet. All right, do your research if you don't know what the yield curve is, and I'll talk about it some other time. Or ask a question in the comments, and I'll talk about it in next week's video. Now, next one here says, when it comes to trading, swing trading, options, etc., I find myself getting paralyzed by the charts. On the 5-minute shows a bull flag, but the hourly shows the head and shoulders. On the 4-hour, it shows an inverse head and shoulders. Basically, so many different time frames show me different things, both bearish and bullish. Which time frames do you find work best for short to medium term trading, swing trades, options, 2 to 4 week plays? And to keep it simple, if you're doing 2 to 4 week plays, the 1 minute, 5 minute, 15 minute ain't gonna do you much good, right? So I personally, I stick to the daily, weekly for sure, because they cut out a lot of that BS, right? Maybe you can drop down the 4 hour, look for, you know, a lot of confluence. I'm always looking at, because if you can find something that has, it's coming down in support, say you're going long, right? And you're coming down in support, right? And then you have maybe a 50 moving average right there. Maybe you have a, you know, 4 hour fair value gap that's coming down into, then you're going to have a lot better chance of success going forward. And plus, remember, it don't matter if you're picking a stock or not. If the market's going down and you're trying to go long, you probably ain't going to work out for you. So do not try to fight the trend. And so that's why I'm looking at the daily and the weekly trend, right? It's going to show you if we're in an upswing on those two, you have a much better chance of success if you're going long. If we're in a downswing and you're going short, also much better success. But anyway, in the comments, if you do a lot of 2 to 4 week swing trading stuff, let us know what you think about that. But definitely daily, weekly, maybe some lower time frames for a better entry, okay? Hope that helps out. Now, last one here says, I've been interested in trading oil futures, but have a small account. What ETF do you recommend that follows oil futures or just oil, like QQQ or NASDAQ and SPY and S&P 500? What's a popular one for oil futures that has volume? I don't know if you're actually asking about futures. I mean, this is futures. You're typing oil futures and you'll have CL, MCL is the micro, and then E-mini crude oil futures is QM. But if you're actually just asking about ETFs in general, I'll just go ahead and look over here at Blake, because he put a pretty good one right below your comment, which says, I use SCO for a short play and UCO for a long. They're both Ultra Bloomberg oil ETFs times 2x in leverage. But when you look at the periods of the moves, I have not noticed really much decay, as I do not buy and hold for more than a few days to up to 2 to 3 weeks. So hopefully that answers your questions. If it doesn't, please feel free to put some more detail in the bottom and stuff. But hopefully it does. And I appreciate all you guys' help as usual. Tomorrow we'll do a video and set it up for the week. See if we get a nice bounce, because Friday obviously was a V-shaped recovery pretty much. And so we'll see what's going on next week and stuff, and set up the charts and everything. So please hit the like and subscribe button on your way out. And I'll see you guys tomorrow.